Good morning and welcome to Moneycontrol. Well, these are testing times for Indian stock markets, trade tensions, visa woes, shifting foreign flows and tepid earnings growth. It's not surprising that so far India has been a laggard compared to other world markets. Is this pessimism kind of overdone? Is this realistic? Could things really turn around from here on, or could there be more pain ahead? We have with us a very experienced India analyst and an expert in emerging markets, strategist, Adrian Mowat. Adrian, thank you so much for joining me this morning.
Pleasure.
First question, of course, Adrian, I want to get a sense of the big picture from you. The starting point for everything that goes around in the global stock markets, financial markets, is really Fed rates. And if you see, there are lots of contradictions coming up. If you look at the labor market data, it's weakening. Inflation risk seems not contained, at least not in the level that Fed should be happy about. Where do you think realistically rates are headed over the course of next 3 to 6 months? Is the market really anticipating a little too much?
I think you've summed it up very well. We have this conflict between inflation numbers, which are above the Fed funds target, and labor market data that seems to be softening quite quickly. I'd also suggest that when we look at capital spending, it's very concentrated in data centers, in AI, and looks relatively weak in the balance of the economy. So I think the Fed has a real challenge here. And as capital market investors, we should really be open-minded about the direction of the Fed. It is possible that if you get the combination of continued weakness in the labor market and the inflation data becomes a bit more acceptable to the Fed, that we will get 2 more cuts in the Fed funds rate. But I do think there is a risk here that with a weak dollar, with an environment where US business confidence is being impacted by the sort of rapid change in policy that we're seeing out of the Trump administration, that you could see ongoing pressure on wages despite the weak labor market, and that's because of what's going on with immigration. We've had the H-1B visa story this week as well. So I'm in the camp that probably the market is a little bit too optimistic on the number of cuts this year. And, we should be cautious in putting in place a trade, which is all about easing of Fed policy. In saying that, I still think the dollar will remain relatively weak, which means that central bank policy outside the US has a lot more flexibility. Interest rates can be cut outside the US if that is what's appropriate for those economies.
And what does that mean for global fund flows? Because all of this year, dollar has actually depreciated significantly, right? At the start of the year, it was 110 or so. Now the dollar index is close to 97. Now, and most of the emerging markets, in fact, money has moved out of US into most of the developed markets. So how do you see global fund flows getting organized over the next 3 to 6 months?
I suggest there are 2 big trends at work at the moment. One is investors' confidence in bond markets, whether they're US or global, is relatively low. They are concerned that yield curves are still far too flat at this point in time, that you're not getting incentivized to take duration risk. And we're doing that when concerns over fiscal stability or sustainability are rising. So we're seeing a move out of bond markets. There are news stories overnight indicating that a very large auto supply company was having credit problems. So it's quite possible that credit spreads will be rising as well. So demand for both investment and junk grade corporate paper weakens. So we have an outflow from the bond market. We also have an outflow from dollar-based assets. And we're seeing this pushing up European equities. We're seeing this pushing up emerging market equities, Japanese equities. It's also flowing into, let's say, alternative assets such as gold, crypto, as investors look for an alternative to what is a very big capital market, that being the bond market. So the flow will continue, in my opinion, for the balance of 2025, out of US assets, out of fixed income, and EM will benefit from that flow.
But if you look at flows and market performance themselves, this time around, it looks like a lot of other developed markets, especially European markets, seem to have done exceptionally well. Is the case for emerging market equities, do you still hold out that case for emerging market equities? Because barring Japan and China, most of the other markets don't seem to have done too well.
You know, we've had good moves in China. We've also had good moves in the Brazilian equity market. So there are markets that are performing well in EM, but you're absolutely right. You know, European equities have been doing very well, and it's been quite concentrated into European financials and some defense stocks. Things like pharmaceutical have been negatively impacted by US healthcare policy, and also luxury goods companies have also been performing well. So the European trade has been very much banks and defense. And remember that, you know, the global equity market is very dominated by the US equity market. So small flows out of the US equity market have a disproportional impact on these smaller other markets that they're going into. I would concur with the view that this isn't a broad EM story. You need a good fundamental driver for the market performance. And so, you know, in Brazil, we've got you know, some more flexibility on around monetary policy. I think in China, it's quite an interesting story of shareholder value. There's been a big pickup in dividends and in share buybacks. Plus, you've got a market that's got a large concentration in tech-enabled businesses, which are doing very well. I would note Alibaba was up 6%, you know, in the mid-morning trading here. So we've got large cap Chinese tech names doing very well. Unfortunately, India's got quite a number of policy headwinds. Clearly, and you know, clearly it's unfair here and to some extent, but you know, both India and China are buying Russian oil. The US government's decided to go more after India with punitive tariffs. That situation is now being compounded by their policy on H-1B visas. So I think the Indian market, which started the year relatively expensive, had been an outperformer over the last couple of years. At the delta, the change on the margin has been adverse for India, where for other emerging markets, the change on the margin has been more positive. So I still think China is going to outperform India for the balance of 2025.
So the pet peeve against, you know, emerging market funds is that, you know, there is at least one or two of the markets perform and two or three of the big markets don't perform. And overall, EM as an asset class has been some kind of a disappointment over the last 10 years. And that is why people have been sort of pushing back and saying that, you know, emerging market as an asset class is not really a superior asset class. And we also saw money flowing into, you know, single country funds, including in India. Again, do you think that perception of India, of possibilities of, you know, single country funds focused on Indian markets, is that money coming back to India? Do you think we are poised at a stage where we can attract that kind of tactical flow? Or the overall emerging market narrative will need to change for India to be a beneficiary?
It might be more constructive to talk about non-dollar based markets rather than just EM narrowly. And as I was indicating earlier, there is definitely much more willingness to switch out of US capital markets into other capital markets. And money is flowing into emerging markets. The MSCI emerging market indices is up 28% year to date. That's a very, very healthy return. But we talk about this very diverse asset class as sort of conglomerated into one particular indices as if it's going to have the same characteristic across all the markets, across all the sectors. And my experience in emerging market investing is you should look at the large sectors in countries and think about how they are going to perform. And at this point in time, you have large sectors in the Taiwanese market, particularly stocks like TSMC that are doing incredibly well. In Korea, which is one of the top 3 emerging markets, we've got both the tech sector as well as the heavy industries, which are defense suppliers, doing very well. In China, we've got large cap tech-enabled businesses doing extremely well, and that's driving the indices. And so I think we have a nice combination where there's a willingness to buy non-US assets, and in the markets, in the sectors that are producing good fundamental story, they're attracting very large capital flows and are giving you high returns. But at the end of the day, we can talk about indices, we can talk about asset classes, but in the equity market, you're buying individual stocks, which then aggregate into a sector, into a country. And we always need to come back to where are we seeing a delta that's positive in terms of people's perception of the fundamentals. And we are seeing that in the 3 biggest markets in EM.
So as far as India, what would be that pocket? Because traditionally, when large money flows came, they came, obviously, the larger chunk of flows only comes through the ETF route or the index fund route, which means the largest companies, largest market cap companies usually tend to be the beneficiaries. It could be the HDFC banks of the world or, large companies. Do you see, and recent times we've seen a lot of optimism around, new age companies like Eternal, because that also ties in with the global theme that tech is going to it will have a long runway of growth, and here 2 companies have demonstrated that they can grow fast. Is that where a lot of FII interest will now be concentrated, if it is a tactical move?
Yeah, I honestly think that's a bit of a struggle at this point in time. We've got sectors, major sectors elsewhere in EM that are doing well, that have the momentum, the good news flow. And in India, the market is lacking the relative momentum. And we're seeing some policy decisions by the US that are adverse to significant sectors in the Indian equity market. And that's happening in an equity market which still has a premium valuation to it. So I think at the moment, the preference will be for non-Indian emerging markets. Now, how do we change that? Well, perhaps if we can get some resolution between the United States and India so that these punitive tariffs are removed and the relationship becomes a little bit less adversarial. I'm quite concerned about the Indian IT companies and how they deal with the H-1B visa situation. Because even though you can offshore a lot of stuff, you still need those people that are on site with your key customers that are managing the whole offshoring activity. If we think about the major petrochemical plays in India, if their access to inexpensive Russian oil is going to diminish at the margin, that's going to be bad for their profitability. We have punitive random tariffs on steel that impacts another sector that's important for the Indian market. So at this point in time, typically an India bull, at the moment, think India will continue its underperformance.
Understood. But where do you think the trade, what is your best guess? I know this is quite a, issue that, everybody can have a view on, but what is your general sense on where is this negotiation really headed? What will be finally settle at looking at the economic realities, or should we not look at economic realities at all for 1 or 2 years?
Gosh, look, I find it quite difficult to keep up to date with the announcements of the Trump administration. The Trump administration's comments around Ukraine, the war in Ukraine. A month ago we had President Putin of Russia in Alaska at a summit. Now we have overnight President Trump of the United States announcing that he thinks Ukraine could take back territory. The rhetoric around sanctions seems to be accelerating again. But the problem with this is there doesn't seem to be a consistency in the strategy and the policy. So it is very difficult, I think, to make investment decisions because you've got a strong view in what the US administration is going to do.
How do you think, these trade tensions, because at the start of the year, everybody was expecting that India would get not only a deal, but also a good deal. Does this really mar the India growth story in some ways? Because, for example, nobody could have imagined even 2 weeks ago that this, there is even an outside chance that an outsourcing act could come, and could that derail our story? What are the implications in terms of medium to long-term story for India?
So, if you look at the Indian economy is consumption and services. Manufacturing is reasonably modest, although there are certainly centers of excellence when it comes to manufacturing. And so we need to be thinking about what is influencing the Indian consumer in terms of job growth, wages growth. And at this point in time, there's probably more headwinds than tailwinds when we look at that. And then if we think about the service sector, the outsourcing sector, which has been very, very successful in India, at the moment, there are significant policy headwinds. Now, these are well-managed companies, very experienced, now quite mature. I think first invested in Infosys back in '93. They will manage around these problems, but in the near term, I don't think you're going to make good money owning these until they can see a stabilization in the policy and then can develop a strategy around it. So for now, it looks like a tough environment in India relative to some of the other major emerging economies I'm looking at.
Adrian, can you give us a sense of, the earnings recovery picture in the rest of the region or non-dollar equity markets versus India? Where does it stack? And how do you see, you've tracked India for a long time, and the Indian economy, and all economies have this natural, cyclicality, right? They bounce back at a certain, after a certain time. What would be that point where, the economy sort of comes back? Because even in the headline figures, we don't see a concern. But when it comes to the listed universe, the earnings seems to be not growing as much as much as the GDP number would suggest. So what is going wrong here? How do we compare with the rest of the world on earnings?
So it's almost impossible to find an equity market where the earnings perfectly match the overall economic conditions, the GDP statistics. So it's very, very sector specific. And so what we're seeing elsewhere in emerging markets is in certain parts of the tech space, particularly those that are leveraged into data centers, into AI capital spending, they're doing well. The numbers are being revised up. A number of the major Chinese tech stocks are massive players in cloud computing. They have their own large language models, their own applications for AI. Those are doing well. Defense spending is also driving the heavy industry companies in places like Korea. So there's a positive EPS story there. But I think more significantly, I would argue in terms of what's driving markets is that the level of share buybacks plus increases in dividends has been quite marked in the last 12 months across key markets. But I particularly focus on a market like China. And that, when combined with the capital inflow into emerging markets, is providing a very, very positive technical background. At this point in time in India, at a macro level, I'm struggling to identify a sector that is, in my opinion, likely to generate positive earnings revisions over the next 12 months. Now, that might just because I'm simply missing a micro story here, but when I look at it at a macro level, it is quite difficult to see that.
What would you correlate this period that we are seeing of, earnings growth deceleration to any time in the past in India, because you've tracked it for more than 25, 30 years. What period would you relate to, or is the market and the economy, change complexion so much that it's completely erroneous to make any comparison to the past?
I think it's very difficult. I mean, you could do it maybe perhaps at the sector level, but I don't think it's possible to do it at the index aggregate level, because as you highlight, the composition of the market changes over time. And I would also, remind people that the stock market is not a perfect analogy of the overall economy. So some of the macro indicators that you look at that might have a lot of delta in them may not have a big impact at the micro level. I mean, if you, let's look at consumer discretionary in India. Consumer discretionary tends to be dominated by the auto sector. At this point in time, Tata Motors is having to deal with a very significant cyber issue for their Jaguar Land Rover business. That's got nothing to do with the Indian economy.
Understood. So, if you look at the global landscape, Adrian, there is a lot of conversation around AI. Most of the stock movements in the US is also both in the listed and unlisted space. AI stocks seem to be doing too well across the region also, including in China. Do you think there is a bubble, and what could be the repercussions? What is your prognosis? If you look at previous market cycles, what does this, can you put this in context of the previous market cycles and bubbles?
Yes. So, this would take me back to the late 1990s when you had the dot-com bubble. And India was quite a big beneficiary of that. You had very large moves in stocks like Infosys, TCS, Wipro, etc. But what was going on there in the US equity market was you were buying into many stocks that were not making money. And even if you're buying into companies that were making money, such as Cisco, the network equipment company, they were on a very high price to sales ratios. So this time around, the market is being led by companies that are profitable. Valuations are certainly high. Balance sheets are very strong, with most of these companies very cash flow positive and having large cash reserves. So I think valuations are too high and people are too exuberant, but I don't see a bust of the magnitude that we saw through 2000 and 2001. It's also worth remembering that what burst the bubble in 2000 was the Fed tightening policy, which it did in March 2000. And that really marked the top of the NASDAQ market and led to a 2-year significant decline in P multiples across most sectors in the United States, but most pronounced in the tech sector. So I'm uncomfortable with the valuations, but I'm not going to describe this as as a bubble that's going to burst with severe consequences. There are, at a micro level, there are stocks such as Palantir, which clearly has very high sales growth. But when you look at it on a price to revenue basis, it does look excessive, very hard to actually grow into those sorts of multiples. But when I'm thinking about the Amazons and the Metas, even to some extent Nvidia, these businesses are very, very profitable, generating a lot of cash flow. Perhaps valuations can come down a bit, but I don't see these things as bubbles that go to bust.
Understood. One final question, Adrian. What is your take on gold? Because you look at gold today, you are colored by how it is performed over the last 4 years, this de-dollarization trend, and then you say it's gone up so much, how much more can it go up, because you don't even have an underlying like earnings against which you can benchmark what the price of gold is, whether it is fair or not. On the contrary, the central bank de-dollarization itself is such a huge mega trend with no other credible asset where such large amounts of money can really get deployed. So from a medium to long term perspective, what do you think could be gold's trajectory, and how do you think about even as a tactical move, what would you think should be gold's? What should we expect from gold?
So at the moment, gold has got momentum. It has marginal buyers, and the marginal buyers was, as I was discussing earlier, people moving out of bonds, looking for alternative assets, which is pushing up crypto, pushing up gold. We know that central banks are looking to diversify away from the dollar. This may be partly defensive and wanting to own non-sanctionable assets, plus also recognizing that there's momentum in gold. Other currencies are doing better than the dollar. So, gold is a greater fool asset class. As you note, it's got no fundamental basis for owning. It costs you money to own. It doesn't give you a dividend yield. You can't value it in terms of cash flow. So it's all about, what is your strategy and thinking why there might be more people wanting to buy that gold that you already own. And I think investors at the moment should continue to enjoy the ride, but should be much more thinking about what are the sell signals to get out of what's been a very significant move in an asset class. Now, people think gold is very liquid, but it's a single asset, not a particularly liquid market where flows tend to go in one direction. And so price movements can be quite dramatic. So my advice at the moment is, okay, continue to enjoy the ride, but think about what the sort of sell triggers are going to be.
Understood. Thank you so much, Adrian. That's all. That's all we have time for. Thank you so much for joining us this morning.
Pleasure.
Thank you so much for watching us. Stay tuned to Money Control for all your news updates.